Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. The upcoming union budget will be the last full year budget ahead of the Lok Sabha elections. The finance minister is expected to lead India on the growth path while keeping the fiscal deficit and inflation in check. The macroeconomic concerns will be the subject of much debate and discussion. Meanwhile, there have also been calls from the industry to extend tax benefits to the common man. It's this more personal part of the budget exercise that Bhashwar Kumar will focus on today and answer how your taxes and investments are likely to be affected.
The government is examining the possibility of increasing the tax-free slab to 5 lakh rupees under the alternative personal income tax regime in a bid to make it attractive. You may have to pay lower taxes if the threshold is increased, thereby leaving you more disposable income to spend and invest. The alternative personal income tax slabs with lower rates were introduced as an option in the Union Budget 2020-21. At present, only a fraction of taxpayers have opted for the alternative tax regime. At present, income up to 2.5 lakh rupees is exempt from taxation under both the old and new tax regimes. Income between 2.5 lakh to 5 lakh rupees is taxed at the rate of 5% under both the regimes. An individual with a net taxable income of up to 5 lakh rupees is allowed to avail of a tax rebate of up to 12,500 rupees under Section 87A in both the old as well as the new tax system. So effectively, the tax liability of individuals with income up to 5 lakh rupees is zero under both the tax regimes. However, for many taxpayers, the outgo in the older personal income tax regime is lower if they make use of deductions under Section 80C and Section 80D. Government sources have told Business Standard that the issue has been taken up in the budget exercise. However, any proposal to tweak the new regime would depend on its impact on the government's revenues. There could also be a discussion on whether both the old and new personal income tax regimes need to be tweaked. So, how would such a move impact you and other taxpayers?
If the rate itself is changed, not only will it benefit those that have income up to 500,000 or 5 lakhs, it would also benefit those earning higher because the first slab itself will be subject to zero tax. So there would be zero tax impact on 2 lakh 50 to 5 lakhs, and hence that would have a trickle effect on those earning income beyond that as well.
There is a ask to increase the tax-free slab to 5 lakhs as part of the alternative personal tax income tax regime. This essentially implies that currently the 5% tax between 2.5 lakh and 5 lakh income per year, which works out to be about 12,500 tax. By making the tax-free regime up to 5 lakhs, essentially we're putting 12,500 rupees in the citizen's hand. I feel the savings will translate into higher investments. And overall, I believe that it's a simplification and a rationalization of the tax regime, which is good.
According to experts, the new regime has benefited non-residents more, since they do not claim significant exemptions and deductions. But a salaried person will be at a disadvantage if he opts for the new regime, since no deduction is allowed for items such as leave travel allowance, house rent allowance, standard deduction, Section 80C and Section 80D. As such, between the new and old regimes, which one would be a better option and for whom going ahead?
Those, for instance, that still have a significant amount of deductions and exemptions to claim, they would not possibly move over to the simplified tax regime.
Discussions have also been held about what the government could do regarding the capital gains tax regime in the upcoming budget. After the last union budget, outgoing Revenue Secretary Tarun Bajaj had said that the current capital gains tax regime needed a complete relook, with streamlining of the various rates and holding periods being necessary. The holding periods and rates of capital gains tax differ for different asset classes. As an example, equity and equity mutual funds attract short-term capital gains tax of 15% and long-term capital gains tax of 10% for gains above 1 lakh rupees. While short-term capital gains tax on most bond investments is at the tax slab the investor comes under, long-term capital gains tax is either 10 or 20% depending on whether it is a listed or unlisted bond or a debt mutual fund. For real estate, long-term capital gains tax stands at 20%. The Confederation of Indian Industry has recommended that the holding period for all capital asset investments, except immovable property, be reduced to 1 year. It has also asked for short-term capital gains tax at a blanket 15% and long-term capital gains tax at 10% for all market investment assets. However, there is some uncertainty on this front. For one, a reduction would go against the practice in other markets like the United States and the United Kingdom, which have increased capital gains tax over the past few years. Also, a government official recently told Business Standard that restructuring capital gains tax would be a separate exercise and might be done outside the budget, since it calls for extensive deliberations with all stakeholders. So, what, if anything, can be expected on this front? And what would be the impact of the industry's recommendations?
I feel that the rationalization of the capital tax regime is a great idea. Today, we have different timelines for equity holding. Long-term capital gains kicks in at 12 months. For debt mutual funds, it kicks in at 36 months. For property, it kicks in at 24 months. I think rationalizing both the time period and the quantum of long-term capital gains is a great idea to spur more investment on the retail side.
But not everybody thinks that any relief will be provided on the capital gains front.
Last 30 months, our markets have performed extremely well. Even the last 6-7 months, we have outperformed most of the global markets, which means most of the market participants and investors have made good money. In this sort of a scenario, I don't see the government offering more SOPs for investors. Equity market investors are paying STT. That's why the difference in treatment. And I don't believe this will be extended to other asset classes. They may provide clarification on grandfathering benefits, but again, don't expect any major changes.
India's top business leaders and industry bodies have asked Finance Minister Nirmala Sitharaman to rationalize income tax rates to increase consumption amid sticky inflation. A number of experts feel that it will also make sense to cut capital gains tax if the government wants to push its divestment program next year. However, others believe that while tax proceeds have been healthy this year, the fiscal deficit could still pose a challenge. Ultimately, it is this factor that will inform any decision by the Finance Ministry during the upcoming budget.
The expected rationalization of income tax rates in the union budget next year will mean you will have more disposable income to invest and spend. But how safe is your money in bank accounts? In one of the biggest incidents of cyber theft from an individual in the national capital, the director of a security services firm lost $500 million just last week. The attack is only the latest in an increasing number of cyber scams aimed at your bank accounts. How then can you protect your bank accounts from such cyber criminals? Debar Gasanyal looks for the lock and key.
Your bank accounts are not quite as secure as you think. With the near ubiquitous use of phone numbers to verify financial transactions, our 10-digit mobile numbers has become the key to our bank vaults and thus a prime target for cyber attackers. A few months ago, a Mumbai-based textile businessman lost around 1.8 crore rupees from his account after receiving 6 missed calls on his smartphone. The money was stolen in 28 transactions across 14 bank accounts by the conmen. A chemical businessman and another person in Ahmedabad lost about 64.4 lakh rupees to cybercriminals following missed calls on phones in January this year. With the rising popularity of mobile banking apps and UPI transactions linked to bank accounts and cards, how does one secure his accounts against such attacks? Salman Waris, managing partner at TechLegis Advocates and Solicitors, explains.
See, normally bank accounts are compromised because of either lack of awareness on part of the customers when they end up divulging their confidential details inadvertently to people posing as bank employees or official government employees, or they are compromised when there is an identity theft or in case of a phishing attack. I think some of the precautions that people can take are to be alert and aware of the various kind of frauds that are going on online. Phishing attacks, never click any links, or whenever there is a request for OTP, I think thrice or 5 times to be very frank before diverging any OTP.
Cybersecurity experts as well as law enforcement agencies point to SIM swap as a new and emerging technique for phone-based frauds. It is a kind of account takeover fraud that generally targets a loophole in the two-factor authentication or two-step verification in which the second factor is either a text message or call placed to a mobile phone. Scammers also contact people's telecom service providers and trick them into activating a new SIM card. Once the new SIM card is activated, cybercriminals take control of the bank accounts and wallets connected with this number. They not only receive SMS-based OTPs, they can also listen in to calls prompting OTPs. Ashwin Chawla of Escropay believes it's time telecom service providers also take precautionary measures.
Giving you an example, Airtel, you go in for a new SIM. Anybody on my behalf goes for a new SIM. Airtel should contact me to say that, well, there is a video protocol required, so that I get first instance information that somebody is trying to get a SIM on my name. And even the KYC, the video KYC, I think that should be made a compulsory thing to do before any SIM card is issued. While issuance of any new SIM card or a second SIM card to anybody, they should make sure that the video protocol is followed, facial recognition, IP address that needs to be taken up, and also the fact that the person who's holding should receive an OTP saying that somebody is trying to, or maybe you've applied for a new SIM card. And don't give it just over the counter. It should be at least a few hours gap before a SIM is given over the counter.
While individuals and companies can take certain precautions and protections to prevent such cyber frauds, this is part of a larger problem that calls for government intervention. Can the proposed data protection bill provide an effective solution to such attacks? Waris has this to say.
From a government perspective, I think there are already provisions under the IT Act, and the proposed data protection bill also criminalizes data thefts. But yes, I think what is most importantly needed is building a culture for cybersecurity. And probably the government can, as part of the provisions of the data privacy bill or the law, obligate companies to conduct regular online campaigns and media campaigns, or government itself can also initiate some of the campaigns.
Chawla, however, proposes a more active role from the government.
I think what the government can do is to basically ask and maybe develop at the government's level a software or an application that has to be compulsorily fed into every mobile device, before anybody buys, or at the parent level.
The menace of phone related banking frauds is increasingly assuming a monstrous avatar. Cyber experts agree that the responsibility for protecting bank accounts should be shared by the individual, service providers, as well as the government and regulatory authorities.
It has been a choppy 2022 for the stock markets amid a host of headwinds. Will the year ahead belong to the bulls, or will the bears reign supreme? Business Standards' Puneet Wadhwa caught up with Abhiram Eleswarapu, CEO and head of India Equities at BNP Paribas, on how he thinks equity markets will play out in 2023 and his sector preferences in this backdrop.
Hello and welcome to the show. I am Puneet Wadhwa. Today we have with us Abhiram Eleswarapu, CEO and Head of India Equities at BNP Paribas. Hello and welcome, Abhiram.
Morning, Puneet. Nice to meet you again.
Same here. What's your outlook for the equities for 2023, Abhiram? Can the markets actually give a negative return as they battle economic slowdown and recession?
Yes, Puneet, to answer that question, we need to consider the three main factors that will drive the markets next year. First and foremost is growth, and broadly we expect growth to slow across the board, especially in developed markets. And we expect a mild recession in both the US and Europe. Maybe India may not have such a huge impact on growth, but still it will be a little slower than what we've seen in the past couple of years. The second element is inflation. Now, that while that is coming somewhat in control, it still will remain above the comfort zone of most central banks, in our opinion. And therefore, next year you will still continue to see tightening by central banks globally, even if not at the same level as we've seen this year. So slow but steady tightening until inflation is within the comfort zone. And last but not least, on valuations, mostly when we look at equity valuations, we try to compare them with bond yields to see the relative attractiveness. And unfortunately, that attractiveness has shrunk quite a bit. And in fact, on a relative basis, bonds are looking more attractive than equities. And probably that attractiveness will only increase over the next few months as rates peak globally. So, in a nutshell, in developed markets, we expect a significant downside to equities, maybe 15 to 17%. Across emerging markets, we expect a modest return that is positive. But I dare say a lot of that may be driven by China reopening. And therefore, India, while we do not have a formal target for the index just yet, I think that a reasonable assumption would be that you will either have flattish markets next year or maybe even some downside.
So 23 belongs to the bulls or the bears, according to you?
As an asset class globally, it will belong to the bears, in my opinion. In India, it will be a bit of a tug of war between both parties, and I dare say the bears may just slightly win it.
Okay. Can you elaborate on your stance for India?
Okay, so in India, what we have to consider is the earnings growth forecast for next year are somewhat optimistic in the sense that they do not factor in a significant downside to risk to growth. That's one element. Then some of the valuation parameters, actually that's the critical element in India is always that, because growth is maybe a little downside to that, but the risk will come from the fact that the market's trading at maybe 20 times next year's earnings, as opposed to the historical levels of 15 to 17 times. And when you take a bond yield minus earnings yield calculation, it comes to something like minus 2.3, minus 2.4. These are levels we've not seen in the last 15 years. And in fact, whenever it has breached that 2.2, 2.3 mark, after that, the returns have been negative over the next 12 to 18 months. So we are in that kind of a scenario. I mean, the mathematical equations are not in our favor for equities at the moment. So the best case scenario probably would be a modest upside. And that's if that's purely on a relative basis that there's no growth elsewhere.
So within the broad equity space, do you find valuation comfort anywhere within the large caps, mid caps, or the small caps back home?
The most comfort that you find on valuation/growth matrix would be on financials. I think banks are pretty much a consensus call, but I still think that valuations are still very much on the positive side or in favorable side. And also, credit growth has been pretty strong, irrespective of deposit growth not matching up. You have a supportive central bank in terms of liquidity. So I think banks in general will do well. So will insurance, especially life insurance and other companies. There are some near-term headwinds there, but by and large, it's a structural story. Two other sectors that I like. One is IT services. Yes, there is a demand slowdown globally, but I think some of that may have been factored into the valuations. And also, even if there is a further downside because of a mild recession elsewhere, you would probably have very minor earnings cuts. I would say below 5% kind of earnings cuts. And considering these are good managements backed by good dividend yields or buyback programs, I think IT services is not a bad place to be. And the last is healthcare. It's not only a structural story globally, but also in India.
So, what is the road ahead for flows, both domestic as well as foreign, into equities, Indian equities?
So, I mean, if you look at this year and try and understand the texture of flows this year, the first half of the year we had very weak or we had outflows from foreign investors. In the second half of the year, that started to pick up. A lot of that flow was driven by the theme of, sell China, buy India, because India was the other large alternative available for those flows. And also, India offers a lot of good quality companies at the end of the day for foreign investors to buy. So that was a theme that played out, I would say, for the past 4 to 5 months or so. But also, India's outperformed significantly compared to China over a longer period, maybe about 18 months or so. Typically, that kind of outperformance does not last that long. And now we're trying to see what we're seeing is China's reopening very gradually on a weekly basis. We're getting some positive news flow or the other on reopening. So my fear is that some of that outperformance may reverse and the trade of, buy India, sell China may reverse. So that's one aspect on flows. The second aspect is what happens because of central banks globally tightening even more. And perhaps what happens on the side of quantitative tightening as well. If all of that comes into play, then the outlook for flows may not be as positive as we've seen so far this year, at least in the second half of this year. So that's on the foreign side. On the domestic side, I still think that flows are reasonably healthy. Over the last couple of months, though, we've started to see some slowdown even on domestic and retail flows. And retail investors have been significant participants in the market this year, but they're also becoming more educated and they do understand valuations are now maybe above comfort zone. So I think that there will be some general slowdown in both domestic and foreign flow, but I still think that domestic flow will be the more predictable and healthier kind of flow.
Thank you, Abhiram, for joining us today. We hope to see you soon.
Thank you, Puneet.
On Tuesday, the markets will take cues from their global peers. Among stocks, Paytm will be keenly watched as the company's board is scheduled to meet later today and discuss a buyback proposal. If the board approves the buyback, Paytm will become the 51st company to announce a stock repurchase agreement in 2022. But what is a share buyback and why does a company undertake it? Rex Cano explains it in our next report.
The board of 197 Communications Limited, the parent of payment services firm Paytm, is all set to meet today to consider a share buyback proposal. Given the company's prevailing liquidity, the management believes a buyback may be beneficial for their shareholders at the current juncture. As per its last earnings report, Paytm has liquidity of over 9,100 crore rupees. Paytm joins over 50 other listed companies that announced a stock repurchase program in 2022. So what exactly happens in a share buyback? A share buyback is a process where a company reacquires its own shares in the open market. It represents an alternate and more flexible way of returning money to shareholders. As the number of outstanding shares decreases, the value of the remaining shares increases after the buyback. Broadly speaking, there are two types of share buyback: tender offer, open market. Under the tender offer route, the company buys back its shares from the existing shareholders on a proportionate basis within a stipulated time period. There are further two types of tender offers. First is the off-market buyback, in which the company specifies the share buyback price and also the proportion at times. Second is the odd lot buyback, where the company offers to repurchase shares from investors who hold less than 100 shares each. Meanwhile, under the open market buyback, the company repurchases its shares through the stock exchanges or a book building process. An open market buyback is more common among companies as it has no legal obligation. However, companies need to abide by norms like buybacks should be less than 15% of paid up capital and free reserves. Only one buyback is allowed in 12 months. Buyback should be completed within 6 months from the commencement. Companies should deposit 25% of the buyback money into an escrow account. At least 50% of the funds allocated are used to report the number of shares repurchased on a day-to-day basis. Buybacks have gained popularity over the years as the preferred mode of returning cash to shareholders in a tax-effective manner, especially after the 10% additional tax on dividend income came into effect in April 2017.
The nation's trusted bank, SBI, the banker to every Indian.
As indicated, buybacks are commonly viewed as offers that benefit company shareholders. But you shouldn't opt for the offer without due consideration. Consider your risk appetite and your financial requirements before deciding to stay invested or taking the offer. That's all for today. Catch the next episode of The Morning Show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.